Hi, everyone. I'm Mike Mazzei, the CEO and founder of Trinity Strategic Wealth. We're delighted to share some information with you today. We started this company in 1996 with the bedrock foundation of seeking first the kingdom of God. And we believe that over time, if we stay committed to our core values of integrity, excellence, and unity, we could deliver on the mission to help you accomplish your dreams, goals, and lifetime values. Well, 30 years later, we have clients in over 40 states and $1.6 billion in client assets. Thank you for the opportunity to serve you. Now I'm going to turn things over to our Chief Investment Officer, Andy Steinmetz, to share some thoughts with you about the markets and the economy and strategy for 2026.
So the way that we typically start the year is we'll take a blank sheet of paper and basically say, what are the pros, what are the cons, what's history tell us in terms of what the market can do this year, 3 years from now, 5 years from now, 10 years from now. As we look at that, one of the things that we're obviously starting with is we've had 3 really good years in a row for the market in the US. We've had 3 double-digit percentage up years in a row. So can that continue for a 4th year? We'll see. But one of the things that we'll typically look at is, what's the price that we're paying for that market? Is it expensive? Is it cheap? What are the earnings or the corporate profits that support that? And what we've seen is, the market is a little bit more expensive than what it's been historically speaking. But at the same time, company profits have been really strong. So we've had, just like the market, 3 double-digit percentage up years in a row in corporate earnings. It looks like we'll have another strong year this year in 2026, and it looks like that could continue going forward. One of the things that's been in the news quite a bit lately in terms of earnings is the amount of money that some of the large tech companies are spending on capital expenditures. So, Meta, Microsoft, Amazon, those types of companies are expected to spend hundreds of billions of dollars in 2026 to fund some of the AI work that they're doing. And those companies make a lot of money. They have a lot of free cash flow. At the same time, the risk is they overspend, and that starts to cut into their profits, which is part of the reason why at the start of this year we've seen some of those companies pull back in their prices. All in all, we think AI is a real thing. One of the things that we're looking at for 2026 is the difference in what we would call the Magnificent Seven companies that you've seen in the market the past couple of years. Whether that's the companies I just named, NVIDIA, Apple, Tesla, some of the others, versus what we'll call the S&P 493, the other 493 companies in the S&P 500. So those big 7 companies have always had their own areas of expertise that they've worked in. Now that they're doing AI, they're starting to compete with each other and cut into each other's businesses. Those other 493 companies are really the beneficiaries of the AI, meaning they're the ones that are seeing higher productivity and more corporate profits because of it. So we feel like those 493 companies will start to perform better as we go forward. We've seen that a little bit here at the start of the year as the S&P 500 equal weight index, which is just those 500 companies equally weighted rather than market cap weighted like the regular index is, has outperformed so far to start 2026. So that's good in terms of what could happen with the market going forward, in terms of broadening out performance and not being concentrated in just a few large companies. The other place where we've started to see this more is in international markets. So similar to the US, we'll look at it and say, okay, what are the things that can make international markets do well? Now remember, for the past 15 years, US markets have really outperformed international markets almost every single year. You've been in an environment where the dollar's been strong. As we go forward, what we're seeing in those markets is valuations are less expensive than the US, which they have been for 15 years, so that doesn't necessarily mean anything. But at the same time, those corporate profits, like we're talking about the US, are starting to strengthen in international markets. So those have been weak compared to the US for the past few years. Those are starting to get better. Part of that is just the reordering of the global economy that we've had over the past 12 months, whether that's with tariffs, trade agreements. There's been a lot of defense spending that's come up in Europe. There's a few different factors there that are starting to drive those corporate profits higher. So one of the things we're looking at for this year, in addition to the US market broadening out, is international markets continuing to have performance going forward. So that's something that we're looking at in portfolios right now. A couple other areas of the market that we get asked a lot of questions about. One is precious metals, gold, silver, which have both had a strong run, really starting last year up until the beginning of this year. There's a few different reasons for that, but we like to remind clients both of those markets are thinly traded markets, meaning there's not a lot of volume there. Gold markets could have some room to run as we deal with geopolitical risk. It is a safe haven. We've also seen a lot of central bank buying for those, for gold, because gold has been a safe haven currency historically. In terms of silver, there's some more industrial use in silver than there is in gold, but at the same time, there's some issues with how the market trades. It's had a huge run up here in the past 12 months. We'd be a little bit more skeptical of silver going forward. The other market that we get asked a lot about is Bitcoin, cryptocurrencies in general. Bitcoin has had some big ups, it's had some big downs over its lifetime, but we feel like we've seen it tilt a little bit since last summer when the Genius Act was put into place, which essentially legalized stablecoins in the US. We'll see what that means going forward, but at least short term, that has kind of been the top for Bitcoin since July of last year. So as we put all the pieces together, like I mentioned, that blank sheet of paper at the beginning, we like to put odds on everything and look at it from that sense as we build the portfolios out. So we feel like the odds are strong that the economy remains strong, as Mike mentioned, corporate profits remain strong, and that can help the market going forward. It's lower odds, maybe 20%, that something goes wrong along the way. Some of the risks that we're looking at are obviously the AI build out. You've probably seen in the news that there's some issues around private credit funds. Some of the other things we're looking at are if trade uncertainty comes back up, if the administration gets a little too confident in what they're doing. But all in all, we feel pretty good about where things go from here, and we're looking forward to what happens in 2026.